Deep Dive, Sable Offshore. Part 6, The Jockey, James C. Flores. All right, let's talk about the man at the center of this whole Sable Offshore story, James C. Flores. In the world of energy investing, especially in tough, cyclical plays like this, people often say, bet on the jockey, not just the horse. The idea is simple. In capital-intensive, regulated industries, a proven leader who can allocate capital, time deals perfectly, fight regulators, and execute under pressure can turn a distressed asset into massive alpha. Flores embodies that wildcatter archetype more than almost anyone alive today. Right now, as chairman and CEO of Sable Offshore Corp, Flores is in the middle of his boldest move yet, resurrecting the SYU, a monster offshore California field with over 1.2 billion barrels of recoverable resources that's been dead since the 2015 Refugio spill. ExxonMobil, the biggest public energy company on Earth, couldn't restart it after a decade of California regulatory hell. Flores bought it cheap in a 2024 SPAC merger with Flame Acquisition, structured it as basically a call option on revival, and is betting everything on federal preemption to smash through local blocks. As of early January 2026, things are heating up fast. PHMSA issued an emergency special permit in late December 2025 to restart the Key Las Flores onshore pipelines. Lines 324, 325, citing a national energy emergency declaration under the Trump admin. Environmental groups rushed to the Ninth Circuit, for an emergency stay court denied it on December 31, 2025. But the underlying lawsuit is expedited. Briefs start rolling in late January through March 2026. Onshore restart isn't fully greenlit yet. Santa Barbara County, Coastal Commission, and state agencies are still fighting hard with fines, permit denials, and new demands for reviews. Production has technically restarted on one platform, Harmony, but full commercial flow is still pending. This isn't just an operational play, it's Flores wagering his reputation and fortune on outmaneuvering the most hostile regulatory environment in the U.S. To understand if you should bet on this jockey, you have to look at his full track record, the legendary wins, the brutal failures, and what it means for SOC's binary outcome. On the personal side, James C. Flores keeps things low-key. He's a Louisiana native and longtime Houston resident, married to Cherie Flores for decades. They were already a couple in the mid-1980s during his early career. They have 4 children. Flores is a proud LSU alum, BS in corporate finance and petroleum land management, and, with Cherie, endowed the Flores MBA program at LSU's E.J. Orso College of Business in the 1990s, still a lasting family legacy supporting education in his home state. No flashy lifestyle or public drama in the record, he's family first, quietly philanthropic, and laser-focused on the business. That stability and long-term alignment likely fuel his willingness to go all in on high-stakes bets like SYU. It's not just a deal for him. It's tied to legacy. As of January 7, 2026, with the Ninth Circuit denying the emergency stay and Harmony platform production technically restarted, though full commercial flow is still pending, the jockey is riding hard toward what could be his biggest win yet, or another brutal wipeout. To understand the odds of success with Sable Offshore Corp, you really have to look at the man driving it, James "Jim" Flores, and his full professional arc. He's not your standard major oil company suit. Flores is a classic wildcatter, deal-savvy, litigation-ready, leverage-hungry, and always hunting for mispriced assets. The bet the jockey case here rests on his track record of massive wins, painful wipeouts, and a philosophy built around agency, timing, and aggressive capital deployment. Let's break it down step by step by walking through his career highlights. 1. The philosophy of the jockey agency. Risk and the wildcatter mindset. Flores doesn't play small ball. He's a throwback to the old-school independence, master of timing acquisitions at the bottom, bulldozing regulatory barriers with legal firepower, and engineering creative, sometimes high-wire, financing. Think SPACs, seller-financed high-interest notes, PIK toggles, and heavy insider alignment. That alignment is real here. He personally put up $25 million to help close the original SPAC deal when others hesitated. As of recent filings, through mid-2024, with no major sales reported since, he holds around 10.6 million shares in Sable Offshore, roughly 10 to 11% ownership. At various points in 2025-2026 pricing, that stake has been valued north of $60 to $100 million, depending on share price swings. That's genuine skin in the game downside exposure that motivates him to fight hard. But it cuts both ways. High personal stakes can lead to gambling for resurrection moves, like accepting 15% interest on the Exxon loan extension or pushing hard on restarts amid regulatory fire. 2. Early days. Building the foundation. Flores got his start in the late 1980s/early 90s amid the post-1986 oil crash. He co-founded Flores and Rux, Inc. in Louisiana, scooping up mature, distressed fields that the majors were dumping at fire sale prices. They squeezed out incremental production through smart ops and acquisitions. The company went public in 1994. By 1997, it rebranded to Ocean Energy Inc. and merged with United Meridian Corporation in 1998, adding Gulf, North Dakota, and even early West Africa exposure. Another merger followed with Sable Energy in 1999. Classic roll-up strategy: aggregate assets, build scale, boost cash flow, and position for bigger plays. It established his reputation as a dealmaker who could grow independence fast. 3. The masterpiece: Plains Exploration and Production. This is the chapter that made him a legend. In 2001, he took over as chairman and CEO of Plains Resources Inc. He spun off its E&P assets into a pure-play upstream company, Plains Exploration and Production, in 2002, then went on an aggressive acquisition tear. 2003, bought 3 tech energy added Gulf of Mexico exposure. 2004, acquired Nuevo Energy, massive consolidation of California heavy oil assets, foreshadowing Santa Ynez. 2007, landed the transformational Pogo producing deal. Huge scale-up, followed by smart non-core sales. Plains Exploration and Production grew production and reserves dramatically over a decade. Then, in 2013, he timed the exit perfectly. Sold it to Freeport-McMoRan for about $20 billion, cash plus stock, when WTI was hovering around $95/BLL. 18 months later, oil crashed below $50. Shareholders dodged the downside bullet. Textbook top tick, sale proof of his buy low, sell high timing superpower. 4. The Icarus Fall. Freeport-McMoRan oil and gas post-merger. Flores became vice chairman of Freeport-McMoRan and chairman/CEO of its oil and gas subsidiary. The deal saddled Freeport-McMoRan with about $20 billion in added debt just as the commodity supercycle peaked and reversed. Oil prices tanked, mining troubles compounded, and Freeport-McMoRan hit crisis mode. Dividend cuts, forced asset sales at depressed prices, massive restructuring. Flores stepped down in 2016 amid the fallout. It tarnished the shine, showing how his aggressive, leverage-heavy style can amplify destruction when macro conditions turn vicious. High risk can mean epic wins or epic losses. Flores' career is a roller coaster of aggregation wins. Ocean Energy, Plains Exploration and Production, perfect cycle timing, 2013 exit, and brutal downturn pain, Freeport-McMoRan era. At Sable Offshore, he's applying the same playbook: distressed asset grab, Santa Ynez from Exxon, heavy personal skin, regulatory warfare, creative financing, and a bet on restarting legacy infrastructure in a high-price environment. The odds? If oil stays supportive, regulations bend, or get bulldozed federally, and the aging pipes/valves hold under pressure, this could be another Plains Exploration and Production style masterpiece. But if the regulatory gauntlet drags on, a spill/incident happens, or prices weaken, it risks echoing the Freeport-McMoRan downside. That's why betting on Flores is betting on the jockey, not the horse alone. High conviction, high variance. 5. The Red Flag: Sable Permian Resources bankruptcy. This chapter is the biggest cautionary tale in Flores' career, the one that proves even a legendary jockey can crash hard when leverage meets a brutal market downturn. Sable Permian Resources, SPR, originated from the remnants of Aubrey McClendon's American Energy Permian Basin, a spin-off after McClendon's 2016 death and prior Chesapeake fallout. In 2017, it restructured and emerged as Sable Permian, with Flores stepping in as chairman, CEO, and president to try to turn around the debt-heavy Permian Wolfcamp shale operator. The hope was his deal-making and operational skills could pare debt, cut costs, and optimize production in a tough post-2014 shale environment. But the setup was already precarious. Complex capital structure with multiple tranches of debt held by sophisticated players like the Energy and Minerals Group, EMG, Onyx Point Global Management, and others. Flores attempted an out-of-court restructuring in 2019 to manage the load amid lingering low oil prices, but it wasn't enough. Then came the double hammer. The 2020 COVID-19 demand collapse sent oil prices negative in April, devastating cash flows for leveraged E&Ps. SPR couldn't service its obligations or grow out of trouble. On June 25, 2020, Sable Permian Resources, LLC, and affiliates filed voluntary Chapter 11 petitions in the U.S. Bankruptcy Court for the Southern District of Texas, Houston Division, Case 20-33193. Filings showed roughly $1.32 billion in total debt, including about $575 million revolving credit and about $744 million long-term notes, 127,600 acres in the core southern Midland Basin Wolfcamp play, but no liquidity to weather the storm. The company secured $150 million in debtor-in-possession (DIP) financing to keep operating during restructuring. The process was contentious. All employees were laid off post-filing as operations wound down. Bondholders/creditors pushed back hard, including scrutiny of executive compensation floors, reportedly sought a significant payout or bonus tied to performance, but it was denied or fought off amid creditor objections. Some reports and distressed analysts, e.g. from Silverback Asset Management, later criticized management harshly, calling the asset base mediocre, drilling overly dense, sacrificing long-term value for short-term results, and overall operations poorly run or even scammy in tone. Filings included lists of putative defendants for potential claims, with Flores and other execs named in connection to possible mismanagement or fiduciary issues, though no major public settlements or judgments against him. Equity was wiped out entirely, control passed to senior secured creditors. The company emerged from Chapter 11 on February 1, 2021, under a third amended joint plan of reorganization and liquidation, reorganized but under new ownership/name, with Flores no longer in charge. Key lesson for Sable investors. This wasn't just bad luck, it highlighted the limits of Flores's playbook. When you can't drill/grow your way out, due to price crash plus high fixed costs plus leverage, and regulatory/market conditions don't bend, aggressive strategies can lead to total equity destruction. No heroic exit like PXP, instead, a messy wipeout that left creditors in charge and raised questions about execution in prolonged downturns. It underscores why SOC's current setup, federal preemption bet, seller-financed debt with reversion risk, binary restart outcome, carries real jockey risk. Flores has the skin and conviction, but history shows his style can go to zero when the macro turns hostile. Okay. Let's keep rolling with this breakdown of Sable Offshore and why it's such a classic Flores redemption story. 6. Sable Offshore. The redemption play. Picture this. Jim Flores sees one of the juiciest distressed assets in the U.S. energy space just sitting there. Santa Ynez Unit, 3 giant fixed platforms. Hondo Harmony Heritage, mothballed since the ugly 2015 Refugio spill dumped over 140,000 gallons into the Pacific. He jumps on it through the Flame Acquisition SPAC. They raised about $287 million, closes the deal in 2024, and buys the whole thing from Exxon for roughly $625 million, mostly seller-financed, with a 5-year note that's now carrying around 15% PIK interest. Smart structure, low cash outlay, big upside if it works. PIK, by the way, is payment-in-kind interest, which is rather than writing interest checks, Sable lets the debt grow over time. That preserves cash in the short term, but it makes the loan bigger and more expensive the longer it's outstanding, especially painful once the interest rate is high, like about 15%. But here's the knife-edge part, the reversion clause. If they don't achieve restart production, meaning actual commercial sales of oil and gas, by March 1, 2026, the assets flip back to Exxon for $0. We're talking a $622 million loan that could evaporate. High stakes. Fast forward offshore, things are moving. They started ramping production in phases back in May 2025. First Harmony platform, about 6,000 barrels a day from 6 wells, flowing to Las Flores Canyon storage but no sales yet. Then Heritage in July, Hondo in August. The well tests? Better than pre-shut-in numbers. A decade offline actually helped repressurization on this heavy sour crude means lower decline rates and solid recovery. They're on a path to maybe 28,000 BE early on, scaling toward the historical peak of 45,000 BE day across all 112 wells. At $70 Brent, which is supportive right now, that full run rate could throw off $400, $600 million in annualized earnings before interest, taxes, depreciation, and amortization. From zero revenue today to about $3 million a day in cash flow? That's the dream. The bottleneck? Those onshore pipelines, lines 324 and 325, 8 miles subsea to Las Flores Canyon, then another 120 miles inland to the refineries. Right now, oil's just sitting in storage at LFC. No commercial transit, no money in the door. 7. The battlefield right now. The 2015 spill didn't just make a mess, it created a permanent scar in Santa Barbara. Beaches closed for 150 miles. Fisheries took a hit. Locals got radical. Fast forward, Santa Barbara County flat out denied permit transfers back on December 16, 2025, citing Chapter 25B operator capability. Coastal Commission slapped an $18 million fine in April 2025 for unpermitted repair work and multiple cease and desist violations. Then SB 237 passed in September 2025, basically says if you've been idled more than 5 years and didn't restart before January 1, 2026, you need a full coastal development permit. State AG has civil charges pending. County DA has criminal misdemeanor probes over the Gaviota work. Arraignment was February 24, still hanging. In simple terms, Sable is fighting on hostile ground shaped by the fallout from the 2015 spill. The accident hardened local opposition, damaged beaches and fisheries, and turned Santa Barbara into a no-tolerance environment for offshore oil. Since then, state and local authorities have stacked new barriers. The county blocked key permit transfers, the Coastal Commission fined Sable heavily for repair work, and new state law, SB 237, raised the bar by requiring full coastal permits for long-idle pipelines. On top of that, both civil and criminal cases are still hanging over the company. The result is a crowded legal and regulatory battlefield where multiple agencies can slow, fine, or prosecute Sable at the same time, even as it tries to restart operations. Flores didn't back down. He went full federal preemption. Argued the Pipeline Safety Act gives PHMSA exclusive control over interstate lines. They even flipped the old 2016 intrastate classification. PHMSA greenlit the restart plan December 22, 2025, then dropped an emergency special permit on December 23, docket PHMSA 2025-1502. Good for 6 months, renewable, backed by the Trump-era National Energy Emergency Executive Order, waived normal notice and environmental assessment. They installed 27 emergency shutoff valves and ran smart pigs to prove the 35-year-old steel is sound. One of the big wins is the Ninth Circuit on December 31, 2025, denied the environmental group's EDC, Sierra Club, Center for Biological Diversity, emergency stay request. Operations can keep going while the full merits case plays out. Briefing is expedited, plaintiffs open January 26th, Sable and PHMSA answer February 17th, interveners March 3rd. Sable and Pacific Pipeline jumped in as interveners. By the way, the Ninth Circuit is the federal appeals court that oversees California and has the power to stop or allow Sable's restart while the legal fight plays out. When it denied the emergency stay, it chose not to freeze operations, meaning PHMSA's federal approval stays in effect and Sable can continue moving forward for now. In practical terms, the court kept the system running during litigation instead of shutting it down first and sorting out the legal arguments later. Flores stopped trying to win permission from California and took the fight to Washington. He argued that federal law gives the pipeline regulator, PHMSA, sole authority over interstate pipelines. And PHMSA agreed, reclassifying the line and approving a restart. Because the government declared a national energy emergency, PHMSA was able to fast-track an emergency permit and bypass the usual slow review process. Sable also made physical upgrades and inspections to show the pipeline is safe. The key legal win came when the Ninth Circuit refused to block operations while lawsuits continue, meaning Sable can move forward for now, as the case is argued on an accelerated schedule. The remaining gating items are not abstract, they're specific choke point permissions. Key obstacles include 1. A Coastal Development Permit, CDP, pathway under SB 237 for long-idled onshore pipelines. 2. A state parks/state lands easement posture for the coastal segment where repairs and access are required. And 3. The CZMA federal consistency fight with the Coastal Commission that can slow or constrain the effectiveness of federal actions. Even with federal safety authority, these state hooks can materially delay sustained commercial operations. But the bear traps are everywhere. Santa Barbara Superior Court, Judge Geck, kept the injunction in place after the January 7th hearing. Sable had to admit, no commercial oil has moved through the onshore lines yet. That triggered SB 237 CDP requirement, 30 to 60 plus day review. Coastal is demanding it apply to the PHMSA permit. Next hearing, February 27th. No restart possible without state parks easement for the 4-mile coastal section, corrosion repairs, plus the CDP. Coastal Commission letter, January 6th. They're asserting CZMA federal consistency review. 30 plus days, clock hasn't even started because no materials submitted. And claiming the PHMSA ESP is effectively stayed until they finish. Santa Barbara County supervisors held a closed session January 5th on the litigation. Fire chief says there's a 24-hour notice agreement for any flow never got. 1. No visible onshore movement. 1 leak or incident? Instant shutdown. The 2015 consent decree is still lurking. Federal side has momentum, especially in the Trump energy dominance environment, but state and local agencies, Parks, Coastal, OSFM, plus the Ninth Circuit Merits Review, could drag full sales out weeks or months. Backup plan. Offshore storage and treating vessel acquire in Q1, install late 2026, offload to tankers, potentially greater than 50,000 back a day without relying on the pipelines. 8. The financial asymmetry. This stock behaves like a coin flip with a big payoff on one side and a wipeout on the other. After the Ninth Circuit ruling, the stock jumped hard, then fell back just as quickly when new state resistance and oil market worries surfaced. That kind of violent swing tells you the market sees this as a binary situation, not a steady business. If Sable clears the remaining legal and financing hurdles and starts selling oil, the upside could be several times today's price, because the asset would suddenly generate real cash flow. If it doesn't, because of delays, court reversals, another incident, or running out of time on expensive debt, the company burns cash fast and the stock could collapse. There's very little middle ground, which is why the volatility is so extreme. Flores has played this brilliantly to date, snagged a Tier 1 asset at 10 to 20% of what it was once worth, forced a federal override against hardcore California environmental opposition, scored the PHMSA emergency permit and the Ninth Circuit no-stay win. That's real execution. But his career is nothing if not binary. Think Plains exploration and production masterpiece versus the Freeport-McMoran wipeout or the earlier Sable Permian struggles. No commercial sales yet, just storage at LFC. March 1st clock is ticking loud. The bet is whether Flores can thread the needle, renew the PHMSA permit, use the OS&T vessel as a bridge if needed, and keep everything leak-free in this Trump-era tailwind. If the pipes flow clean and sales start, this could be another legendary turnaround. One regulatory block, one seal failure, one drip in the wrong place. It's over. High-variance redemption play about $3 million a day potential hanging in the balance. Classic Flores, massive personal skin, north of $100 million stake, creative leverage, non-stop litigation. You're not betting the asset alone, you're betting on the jockey to keep this bucking horse from throwing him. Flores has executed masterfully so far, snagged a world-class distressed asset at a bargain, structured enormous upside optionality, and navigated federal preemption against fierce California opposition. Recent PHMSA permit and Ninth Circuit denial mark real progress toward restart. But his history is binary. Epic aggregations and top-tick exits, Plains exploration and production, versus leverage-fueled wipeouts, Freeport-McMoran era, Sable Permian struggles. Investors aren't just betting on oil prices or reservoirs, they're betting Flores threads the needle without a fatal regulatory, operational, or incident error. This is a high-risk, high-reward bet on execution. If the pipelines operate safely and oil sales begin, Sable could generate significant cash flow and turn into a major turnaround success. But there's no margin for error. One regulatory setback, operational failure, or spill could end the story quickly. A large part of the thesis rests on Jim Flores himself. He has put substantial personal capital at risk, has already pulled off a difficult acquisition, and has made real progress navigating federal approvals. At the same time, his track record includes both big wins and painful losses. Investors here aren't just betting on the asset, they're betting that Flores can manage the legal, operational, and political risks without making a single critical mistake. This is Avi. Like and subscribe. On to the next.